2022 is coming to a close. That means it's time to look at what 2023 will bring in the housing market. We have some information when it comes to inventory levels and how that might impact pricing in this upcoming year. So let's jump into those details and get to the bottom. Variety of data points to go over with you as they relate to the housing market for this next year in 2023, but let's start with some of the information that we have from the Mortgage Bankers Association and their weekly mortgage application survey. This gives us information on application volume as well as average interest rates as reported by a wide variety of lenders that they survey. This data for this week showed purchases flat week over week, which puts them down in purchase application volume 36% year over year. Some good news on the interest rate side of things, as we saw interest rates decline on average from 6.42% to 6.34%. We love to see some improvements there, and we'll talk more about potential improvements and rates we could see in this upcoming year. First, let's take a look at existing home sales. This is a measurement of closings on existing homes, and it showed that sales were down by 7.7% in the month of November. This was weaker than expectations, and on a year-over-year basis, sales are now down 35%. When it comes to inventory levels, inventory is low and has continued to decline, but it is normal to see a seasonal decline in inventory at this time of year. We see that trend year over year. Limited inventory is going to continue to limit the downside in home prices, and that limited inventory really sets us up for a potential reacceleration in home prices in this upcoming spring, as home buyers who might be taking the year off or the season off come back into the market and are ready to make a purchase. When you look at the pace of home sales and how long properties are staying on the market, homes remained on the market for an average of 24 days, which is up slightly from the 21-day measurement we had previously, but still, overall, homes are moving quickly, with 61% of homes being on the market for 30 days or less. Now, Jake, tell us a little bit about what we're seeing when it comes to the actual inventory levels we might see going forward and some of the influences on that number.
Yeah, thanks, Kyle. So we got a couple of reports to go over with you this week with regards to inventory. We got some numbers regarding housing starts, which are down 16% year over year, with single-family housing starts down 32% year over year. We also got the data on housing permits, which will reflect the future supply, and that was down 11% month over month and down 22% year over year. Additionally, single-family housing starts are down 30% year over year. These numbers indicate that we'll continue to see limited inventory in the future. And I want to be clear that this paints a very different picture than what we saw in 2008. At that time, we did have a similarity where demand was at a low. However, the big difference is that in 2008, builders were building a record number of homes, and we're just simply not seeing that happen today. Back to you, Kyle.
Thanks, Jake. Definitely important stuff to keep an eye on, and it's really useful to hear about some of those differences between a slowdown in housing that we're seeing right now compared to a very different situation in 2008. And I'm sure we'll continue to make other correlations to that as we go forward with other data points. But right now, let's take a look at some information we have from Realtor.com. And this data is related to the price of rent. Rent is a really important factor for us to keep an eye on as professionals in the housing industry because it's the other side of the coin, right? You have the ability to either make a home purchase or you're going to pay to rent. So when we look at rent prices, rent growth slowed in the month of November. This was the 10th month in a row that the rate of appreciation or cost increase for rent has slowed. Rents are now up 3.4% year over year, which is the slowest growth rate in 19 months, and a really significant difference from the rent growth rate that we saw not too long ago in the month of January. At that point, the rate was 17.4% year over year. An interesting thing to note is that this lower growth rate in rent could be beneficial and lead to some improvement in the area of inflation. That's a factor that goes into the measurements of inflation, and if we continue to see this contribute to improvements in the readings we're getting on inflation, that could certainly contribute to improved mortgage interest rates in this upcoming year. Inflation has been a real driver of increases to rates this year. So if we see it continue to moderate, that could be good news for us going forward. So we'll continue to keep an eye on that information along with other relevant stories as they come up. We want to try to make sure to bring you the most important data as it becomes available that could help you to best serve your clients and operate in this rapidly changing real estate market. We'll look forward to seeing you next week, and we appreciate you tuning in to The Bottom Line.